You ever look at the stock market ticker and wonder what's really going on behind those flashing numbers? Because let me tell you, it's not just folks in suits on a trading floor anymore. Oh no, it is a high-speed, high-stakes game played almost entirely by algorithms. And today, we're going to dive into how machine learning became the single most powerful player on Wall Street.
So let's just get right to it. The central question for anyone with money in the market has always been the same. How do you actually beat the average? For a long time, the answer might have been better research, a sharper gut instinct, or maybe just dumb luck. But today, the answer is code.
Right, so in the finance world, that edge, that beating the market part, it has a name. It's called alpha. And put simply, alpha is just a measure of your performance after you account for the risk you took. You know, if the S&P 500 goes up 10% and your portfolio goes up 12%, that extra 2%, that's your alpha. It is the absolute holy grail. It's the proof that you're just a little bit smarter than everyone else.
But here's the thing. Consistently finding alpha is ridiculously hard. What's known as the fundamental law of active management really nails it. You need two things. One, a forecast it's just a tiny bit better than a coin flip. And two, the ability to act on that forecast instantly. And that simple-sounding idea? Well, that is what kicked off a multi-trillion-dollar technological arms race.
So yeah, this quest for alpha isn't new at all, but the tools people are using in the hunt, they've gone through a complete and total transformation. It's a story that has a few different parts, and it really starts with the move from those crowded, noisy trading floors to silent, cold server farms.
The very first revolution was just pure automation. You see, before machines could learn, they first just had to learn how to trade. This meant replacing phone calls and paper slips with fiber optic cables and lightning-fast execution. And this change happened unbelievably fast. I mean, it started way back in the 60s with these simple price terminals. But the real game changer, the explosion, happened in 1997. The SEC changed the rules, and it allowed for these things called electronic communication networks, or ECNs. And that right there is what took trading off the physical floor and put it onto servers. The floodgates for competition just flew open, and by the mid-2000s, this all led to the rise of dark pools, which are basically private stock exchanges where huge firms could trade massive amounts of stock without tipping their hand to the rest of the market.
So the result of all this automation is just staggering. Today, high-frequency trading, or HFT, it pretty much is the market. We are talking about algorithms that hold stocks for fractions of a second. And just look at this. They now account for over half of all trading volume in U.S. stocks. The machines aren't just at the table anymore. They pretty much own the table.
But, this shift has really been a double-edged sword. On the one hand, all this computer-driven trading has massively increased liquidity, which is a fancy way of saying it's easier and cheaper for all of us to buy and sell. But it's also introduced these new, scary kinds of risk. I mean, events like the 2010 flash crash, where the entire market just vaporized in minutes for basically no reason, showed us just how fragile this new high-speed ecosystem could be.
Okay, so with the mechanics of trading solved by just raw speed, the quest for alpha had to evolve. It shifted to a new frontier, the why. Why does some stocks go up while others go down? The answer, it turned out, was in finding these predictive signals, what the industry calls alpha factors.
For a long time, the old-school academic view was super simple. This thing called the Capital Asset Pricing Model, or CAPM, said only one thing really mattered: how sensitive a stock was to the overall market. That was it. But then researchers and just really smart investors started noticing these little anomalies, other patterns that seemed to consistently predict success. And this discovery just shattered the old way of thinking and opened the door to a much more complex view of what actually drives the market.
And these factors, when you look at them, are actually pretty intuitive. Value investing, that's Warren Buffett's whole playbook, right? That cheaper stocks often do better in the long run. The size effect just finds that smaller companies tend to have more room to grow. And momentum is a simple idea that winners, well, they tend to keep winning. Entire hedge funds, massive ones, were built just by systematically taking advantage of these simple ideas.
But here's the problem with any good idea on Wall Street. Eventually, everybody starts doing it. Those factors got crowded, the easy money was gone. So to find new alpha, funds needed completely new information. And this led us straight into the current era, the alternative data revolution. A frantic, global search for signals where no one had ever thought to look before.
The scale of this is it's mind-boggling. There are an estimated 500 exabytes of data on the web. Let me put that in perspective.
That is 500 billion gigabytes. To a modern quant fund, that's not noise. That's a massive, untapped ocean of potential clues about where the market is headed. The only challenge is figuring out how to make sense of it all.
So what in the world is this alternative data? Well, it's pretty much anything that isn't a traditional financial statement, and the examples are just wild. You have hedge funds analyzing satellite images of retail parking lots to predict quarterly sales. They buy up anonymized credit card data to track consumer trends in near real time. They even scan the move of millions of tweets to gauge public sentiment. Seriously, if it can be measured and it might predict the future, you can bet someone is trying to turn it into a trading signal.
Okay, so how does this all actually come together? How do you take satellite photos and angry tweets and turn that into an actual executable trading strategy? Well, it all happens through a very systematic, very repeatable process, the modern quantitative workflow.
In this diagram you see here, this is the blueprint for how it all works. Now I know, it looks complex, but just think of it as a factory for manufacturing alpha. On the far left, you have all that raw data pouring in. Market prices, news, that weird alternative data we just talked about. This flows into the machine learning models, which are like the factory's brain. They make the predictions. Those predictions are then used to build an optimized portfolio. And then finally, on the right, the system shoots the trades out into the world's markets. It's a full end-to-end assembly line for turning information into profit.
Let's just boil that whole process down into 4 key steps. First, you source the data, all of it. Market prices, satellite images, you name it. Second, you model and predict. You unleash the machine learning algorithms to find the patterns and make forecasts. Third, you construct the portfolio. An optimizer takes those predictions and builds the ideal portfolio, perfectly balancing your expected return against how much risk you're willing to take. And finally, step 4, you execute and monitor. The orders are sent automatically, and then the system watches its own performance, constantly learning and adapting on the fly.
So really, the big takeaway is this. The hunt for alpha has completely changed the game. This isn't just about Wall Street gurus with a good feeling anymore. It's a full-blown technological arms race, fought by data scientists, physicists, and engineers, all competing for the slightest edge, an edge that now comes from having better data, faster computers, and of course, smarter algorithms.
And all of this leaves us with a really fascinating and honestly maybe a slightly unsettling final question. As these AI systems get more and more powerful, making decisions in ways we can't fully comprehend, what's left for the human investor to do? What's our alpha? It's definitely someone to think about.